We start today's market talk. Leverage investors produce leverage prices. So if you see every day in the morning, Gift Nifty is down 500 points, but on once the market opens, it is down say around 200, 300 points, and at the end of the day, it is only down 100, 200 points only. That is Nifty. It is because initially prices which you are seeing are the ones which are for the ones who are taking the leverage trades. Okay, so every day we see that there is a steep fall at the open, followed by midday recovery. It is because leverage positions are forcibly closed or voluntarily unwound. So, what happens with the leverage position is when you are investing with capital that charges you rent by the day, your horizon is in hours rather than years. So if you're an investor, you're using your own money, you are not bothered, right? Because people know that things will always work out. So any event like Middle East conflict is always an emergency. So people are booking out, getting margin calls, etc., and that's why there is volatility. Okay. So the biggest question is, have we discounted the Iran war risk in the markets? Firstly, I'll show you what is the situation. There is a big disruption in the energy supply. This is the key issue. So if you see here, some of the key ports, which are oil trading hubs, are disrupted. The LNG plants for in the Qatar are shut. So this is a big risk. Refineries in Bahrain, etc., are being stuck, so they are not working. And then Saudi's largest refineries, etc., are shut. So this channel of Persian Gulf and Strait of Hormuz is closed, and that is the reason. So if there was a news that the OPEC has decided to increase the output, doesn't mean anything, because if there is no oil flow which is going to take place, so what does it mean for increase in output, etc. So this is the situation now. This is the India VIX. So first and foremost, you must understand. So if you see, this is a weekly chart. So if you see here, there have been spikes, and whenever India VIX reaches around this level of 21, 23, markets are generally near the bottom, and this is where the it's like this. This was in 24 May, right? Elections. So where the VIX went up, and then it came down very quickly, and then this was the bottom. Again, in 2025, when the Trump first imposed tariffs, the VIX went to around 23 and then came down. Next was when the India-Pakistan war started, and then again it went up and for a week or so, and then came down. And now this Middle East conflict. So the watching of this VIX movement is very important. Now, if you see the daily charts of the VIX, you see here, firstly, it is overbought. It went up for 2 days. Then it corrected when the news came that there is some kind on Thursday about before the expiry about some kind of a truce, but that was a false news. And then on Friday at the close, it went up again. So you'll have to watch this because things will move very quickly. So maximum, I think the VIX can go to 21, 23. Why? Because present reading means that Iran may be contained inside Iran, and US has control over the situation. This is what the present reading is showing. So in this scenario, the present event is discounted, and only thing which can go on is that the conflict gets prolonged, not worsens. So the worsening phase is over, which the VIX is showing. If the worsening state, if it worsens more, then first and foremost the VIX will go up. Now crude is at around 90, and war risk is still there. So that is another indicator you have to see if the things are cooling down. But now what will happen is, if market understands that the worst is behind, then it will attempt to fill the gaps on charts which were created due to war on the downside. So that process will start slowly. So it will not go up tomorrow or day after or something like that. So don't think that there will be an all-time high tomorrow, but the market will start recovering and start looking at other stuff. Now, so first point is how much of the risk is discounted. Lot of risk of the present situation is in the price. Now, the key issue here is that markets have seen Middle East wars before, but rarely one that simultaneously closes a major shipping choke point, involves the Gulf states, and decapitates a government. So this is the first time, and that's why there is a huge spike and big fall in all indices. So, but the key issue is why the things have not broken, because generally people are aware that indices have delivered positive returns 12 months after start of every Middle East conflict. So peak of a conflict provides an opportunity to increase exposure to equities if you can think of slightly longer duration. Now, what happens is Middle East conflicts are adverse for Indian exchange rates. So now if you see, predictably, the rupee, which was stabilizing after the trade deal, has again come back to and hit that 92 level. So it is negative for the currency, because Middle East is not only crucial for oil imports but also as a source of remittances for India. Collateral damage is India's balance of payments and devaluation of currency. So that is what is playing out, and that leads to inflation, and then the scenario of rate cuts is out of the window. Now, a sustained Gulf conflict that destabilizes global energy markets would deliver a further shock to confidence in the market, especially if it triggers concerns that the Fed is less likely to ease monetary policy. So, if inflation gets reignited in major economies, it will derail the central bank's rate cutting plans, starting with the Fed. So, if there is a prolonged disruption of all traffic through Strait of Hormuz, oil prices can go to $100 plus, etc., along with natural gas prices. So, another side effect would be a surge in the value of dollar. And if you remember, when this last oil shock took place, after once the conflict in Russia and Ukraine started, as the dollar strengthened, all the emerging markets and the developing nations' currency just collapsed. So all Sri Lanka, etc., were in dire strait, and Africa, etc., because the imports become costly, and then they were having a balance of payment problem. Now, the key issue is which sectors gain and which ones lose from this war. This is the key issue. So, firstly, disruption in gas supplies from Qatar has hurt the Norsk hydro aluminum capacity, which is there in Qatar, a joint venture which is there. It will result in increase in aluminum prices, which is already being reflected. Then, IT firms may see a slowdown in discretionary spending and project delays in the region. Now, OMCs will be worst affected as their marketing margins will get squeezed. If they are not allowed to raise prices at the pump, their margins will get squeezed. Oil India and ONGC earnings will rise with crude prices, but I'm 100% sure a windfall tax would be coming. Next is LNG. 40% of India's LNG imports are from Qatar. India's city gas distributors and fertilizer businesses are critically dependent on imports. So they will have to purchase spot LNG, which is at double the rate from the rates which have been contracted with Qatar. So margins are expected to compress, impacting stocks like Petronet LNG, MGL, GAIL, IGL, Gujarat Gas, etc. For aviation, like Indigo, rise in aviation turbine fuel price critical to their margins. Then stuff like Asian Paints and Pidilite, they are dependent on crude derived imports, so they would also get impacted unless they are able to raise prices. Then defense. Global conflicts reinforce expectations of higher defense spending, and that is visible in terms of short-term rise in defense stocks. Then things like Kalyan Jewellers, negative as meaningful share of their revenue come from exports. And then there would be second and third order impacts because generally the sentiment gets negative. Now, in the end, it will boil down to how long the war lasts. So right now the market is pricing a temporary geopolitical shock. Be sure about it. Right now it is thinking that it's a short term affair, maybe 3 months, 3 weeks, 4 weeks, etc. That is in the price. So the present risk is for the crude prices due to war. And right now the market is not pricing a supply and demand risk. It is not, it is thinking that whatever are the reserves, they should be able to take care of the duration of the conflict. But in case there is a supply and demand risk which starts, then these will have to get repriced. Now, what can best can happen is that Trump may seek a deal. He may say that okay, he knows that he can't do a regime change, so we will. He says we will leave you in power, whosoever is there, supported by IRGC. If you stop threatening your neighbors and give us a share in the oil. So if this deal is reached, Gulf would return to stability. Otherwise, Iran will remain unstable. War will grow, causing spikes in energy prices and inflation. So you should be clear as to what is the scenario. Now, coming to FIDI data. So if you see, FIs are short in index futures. They have sold index calls and bought index puts. So they are strongly bearish. Now, what the pros are doing, they are long in index futures. They have sold index calls and bought index puts. So they are also medium type bearish. Clients are long in index futures, bought index calls and sold index puts. And moment their positions reach above 6 lakhs, you should start getting worried that there is a big move which is coming in either direction. So they are strongly bullish. Now, coming to see from here, last time when the top was reached, from there the FI's short positions had decreased to around 1 lakh, and from there they have progressively built up index future short positions, and it has increased, and that has led to the big decline in the markets. So markets have come down, and on big days or big decline days, it is they have added shorts in index futures and basically sold calls and bought puts. Now coming to US. So if you see here, US bond yields were coming down, expecting deflation. Now a 10-year yield has spiked as oil prices have surged, stoking inflation fears. So the point is, people are not expecting any rate cuts, etc. But this spike in the bond yields got halted because the job data has come poorly. So now we'll have to see what happens. The biggest risk could be dollar index. It has started going up. Last time also I brought. It is, moment it crosses 100, then that will lead to big decline in the emerging market currencies and big decline in metals, etc. So the gold and silver, etc. will come down, and all other metals as the dollar starts moving up. And this is also because basically due to safe haven demand and higher requirement of higher demand for dollars for all those people who wanting to import crude, etc. Now Brent crude has spiked. It has come to 90 plus levels. I think at this rate it is heading to 100, and it can go to any level depending on how much clogged global supply chains are. So if you see here, gold saw some profit booking. So it is coming down because if there are margins called, people will seek profits from wherever they are available. Similarly with silver, so it is not going back to the previous all-time high. So levels may get maintained. So the first level will be around 70, or next is $50 to an ounce. It benefits from safe haven status and industrial demand, but don't think that earlier kind of spikes are coming. Copper, its prices are coming down as the dollar is going up, and then there is enough stocks in the warehouses which have risen because the prices had gone up, so people started producing. So there is no shortage. But supply side issues in DRC provide a long-term floor. Now, Bitcoin remains sensitive to geopolitical news. So it went up, has come down. So it can go in any direction. It is acting like a high beta stock right now. So the basic point is that risk of sentiment will remain in place. 10-year yield can move down also due to weak labor data, which I told you. Dollar index can break above 100 if hostilities escalate. Gold and silver may maintain bullish trend, but also depends on how the currency moves. And Brent can push towards 100 and above. Copper will consolidate as what is visible. So the US indices also corrected a bit, but more decline were in S&P 500 around 2% or so, and Dow which fell around 3%. But nothing major happened here, right? So now coming to Nifty, see here, this is the major support zone for Nifty. So if you do a Fibonacci retracement of the rise from the lows which were made in April 25 to the top, so it has corrected around 38% retracement has been done to around 24,600. So 24,600 remains a critical level. It closed below 24,600 last week. And this is the support. Now, if this support breaches, then you're heading to around 24,000 and then to 23,500 as per the Fibonacci retracement charts on the weekly charts. So that this is what this is showing. But this should be a good support. Now, let's see another weekly chart. Now, if you see, this is a rising trend line from the COVID lows, right? This was the COVID low of March. From here, this is the rising trend line. It dipped here and then took support and went back. So now what is happening is this trend line is getting, it comes to around 24,300. So if 24,300 gets breached decisively and it trades below this, then 24,000 is just normal breach. And after that, we may see much lower levels. So this is the big risk, maybe somewhere around 22,000. So that's why I had mentioned that Nifty is at a critical level, because once this trend line gets breached, already the support has got breached. So if this trend line, which is coming from COVID lows, gets breached, then there would be some kind of capitulation. So be prepared for it and watch this level. Now coming to daily chart. So if you see here, the first line of support was around 24,600, where Nifty bounced. So if you see, we had 4 trading days. Every time it opened lows at low level, first day at 24,600, then it went up. Then again it closed, then it opened gap down, and then again it went up, took resistance at 24,600. Then it opened above that, went up, then couldn't sustain those levels. And then on Friday, it has closed below this. So the next line of support for very short term would be around 24,300, which this is the same rising trend line which is coming from COVID lows. So if this breaks, then you will have to rethink what is happening, because this is a very good support. This 24,300 levels is a decent support. Market has bounced. The point is, everybody is short right now. So money will not be made on the short side, firstly. So most probably, if this thing breaks up to 24,000, people will book profits and let the market rise. So that should be an opportunity to book longs and then again short. So don't short right now, because market is oversold. But watch for these levels. Now Nifty Bank, this fell around 4.5% last week, and it has come below 20 EMA on the weekly charts. Now if you see the daily charts, it tried to bounce and it has broken that 100 EMA, and now it is precariously poised above the 200 EMA, though it is oversold. So 57,400 should be a critical level for Nifty Bank. So if you see here, both both indices are at critical levels. Now, if these levels break, then the problem starts. And Nifty Bank has come down because private banks corrected 4%, and they are bringing the markets down. So why private banks are bringing the market down? Because FIs are selling them. And the second thing issue is that people are expecting that if there is a risk to the businesses in terms of margins and demand and other issues and earnings, then there would be lot more NPAs as compared to what is now, and the private banks are the ones who have lent maximum, and their valuations were slightly higher. So the one leading the fall is HDFC Bank. So if you see, it has a decent support at 840, 850 level, where on the weekly charts the 200 EMA is there, and this is also selling off because of that index readjustment which is taking place in Nifty Bank. Now Reliance was surprisingly positive last week, but it took support at its 200 EMA at around 1300 odd. So 1300 remains a decent support for Reliance. It bounced from there, but whether this will continue next week or not, nobody knows. So mid-caps are better behaved as such. They didn't fall as much as Nifty and Nifty Bank, which indicates that basically it is FI selling. And small caps were also down around 2.5%, but they have not yet broken those critical levels. The critical levels will break if they come to these levels from which they had bounced earlier. So now I'll cover two stocks. First is Kirloskar Oil Engines, expected to gain from incremental sales from HHP, that is high horsepower generators, 100 kVA to 3000 kVA. In overall power generation, power generator segment, etc. So it was expected to do a lot of increased sales in this high horsepower segment. Further ramp up in industrial segment from large orders won in previous years in nuclear and defense segments. There are new norms, CPCB 4 Plus, Central Pollution Control Board emission norms. So those products are coming up for warranty renewal, etc. So it will have more sales. It can ramp up distribution segment growth and further penetration in exports market. So these are the triggers for Kirloskar Oil Engines. Company has completed the transfer of its lower performing B2C segment to its wholly owned subsidiary through a slump sale. As a result, year-on-year growth rates are not comparable. Its power generation revenue growth for 9 months FY26 stood at 33% year-on-year versus 17% for Cummins, indicating it has gained market share in this period. Demand momentum remains healthy from infrastructure, real estate, manufacturing, and data centers. Improving market share and traction across products ranging from 1000 kVA to 3000 kVA was also supported by ongoing sales and service capability building and consultant-led selling for HHP generator sets. Industrial segment revenue grew 41% year-on-year, 5% Q-on-Q in third quarter, 17% ahead of estimates, supported by strong demand from defense, nuclear, and marine segments. Distribution and aftermarket segment grew 14%, because that is again a big segment about aftermarket support. Largely in line with estimates, growth was driven by higher spare part sales and service contracts supported by an expanding installed base. Exports grew 25%. Growth was supported by continued traction in international markets, particularly in Middle East and Africa. So we'll have to watch out for this. So now if you see here, the revenues grew around 18% year on year. EBITDA has improved 44% because margins have clearly improved from last year. And adjusted PAT was up 57% year on year. So this is why they are doing well. Now, in terms of segmental revenues, power generation, industrial segment, and distribution and aftermarket all did much better as compared to year on year, and they were much better than the brokerage estimates, etc. So they have outperformed. So the third quarter revenue grew 35%. Margins improved by around 2% or 190 basis points. EBITDA rose 59% and PAT increased 57%. So this was a very strong quarter for them. Expect power generation revenue to clock 20% CAGR, industrial revenue to record CAGR of 24%, distribution revenue growth to go around 14%, and total export revenue to clock 17% CAGR. So better product mix is helping the margins. EBITDA margins are on an upward trajectory. So they have reached the double digit now level, 14.5 is expected in FY28. PAT to move around 21% over FY25-28. The critical number, operating cash flows and free cash flows have improved, so they don't have to borrow much. And return ratios, ROE, ROC have also, if you see, gradually improved, and now they are nearly double from the 2020 level. So this is a business which is performing well. Now, this is expected to do around 15-18% growth over the next 2 years, and margins are expected to continuously improve, so 14.5%. And profit after tax is expected to go up 20% plus. So this is the critical part. So there it should do a EPS of around 40, 41 in FY27 and around 50 in FY28. So taking a mean around 45, 46 at around 30 times it is fully priced. So it can trade at around 1400, 1500 easily, and that is what is in the price. And they pay good dividends. So this is important. 20% of their profits they distribute as dividend, so which is good. ROE, etc. are improving. So if you see here, despite a weak market, this stock was on upward trajectory on all 4 days, and now it is overbought. So wait for a dip somewhere closer to 1350 odd levels should be a decent opportunity. Opportunity will come. It saw some sustained buying and it's in momentum despite a weak market. So it's a good stock for long term. The other stock is Schaeffler India. It has transitioned from a traditional bearing maker to a motion technology firm. It has secured major wins in battery management systems and e-axles. So, e-axles is basically when you combine a electric motor, converter, and transmission oblique gearbox. This is basically required for e-vehicles. Following a global integration of Vitesco, the company it acquired, it is aggressively localizing high precision components to protect margins from currency fluctuations and global supply chain shocks. As the Indian auto market shifts towards SUVs and premium vehicles, the content per vehicle for Schaeffler's high-end clutches and transmission systems is increasing. Revenue soared 28% year-on-year, above estimates owing to revenue beat in automotive technology, that is one segment, and exports. Revenue growth was driven by 49% surge in exports, 42% surge in automotive technologies, 23% surge in vehicle lifetime solutions. Vehicle lifetime solutions is their aftermarket division, basically spare parts and repair kits, and 13% growth in bearing and industrials. Now, adjusted EBITDA rose 36% year-on-year, above estimates to revenue beat. Adjusted EBITDA margins expanded 120 basis points to 18.5% owing to better scale and localization. It's a consistent performer. Healthy double-digit growth to sustain. Higher exports due to better penetration in new markets, Southeast Asia, Japan, Korea, and few countries in Europe, and capacity additions, industrial bearings, etc. Sustained growth in VLS, that is vehicle life solutions, due to new products, better penetration, e-commerce, etc., and market share gains. Automotive technologies growth due to order wins, recent large win for e-axles. BIS growth led by traction in power transmission, railways, and raw materials. So, if you see in this quarter, they did a revenue growth of around 27%, EBITDA growth of around 36%, profit growth was around 44%, and they did an EPS of around 22 rupees. And EBITDA margins improved around 120 basis points, and that's why there was a spike in profits. So they are becoming more efficient, and they have done big order wins for all segments for the full year. this calendar year system. So for this was their Q4. So they have done order wins all in all segments. So for automotive technology, they have won orders, new orders, business development, vehicle lifetime solutions, again, good expansion, and bearing and industrial solutions, again, they have got good orders and good business developments. So if you see here, there is a decent improvement in the revenues in all quarters. So if you see from Q1 CY24 to Q4 CY25, there is a constant rise in the revenues. So there is a constant growth which is taking place, and year on year also there is a good growth, and all segments are contributing to increase in the revenue, and strong growth for 12 months or quarter wise in all segments. So if you see here, automotive technologies is providing 35% of the revenue, bearing and industrial solutions 39%, vehicle lifetime solutions 11, and exports and others 15%. Now if you see here, with their growth projections for calendar year 26, they're expected to do a revenue of around, EPS of around 86, and for calendar year 27 around 97. So around, say, take a in between around 90 to 93, you can take a mean. EBITDA margins are improving, so they will move to 18, 19 levels. Profit growth is around 15%. So the point is that this stock with 95 odd, 80 to 95 odd EPS is presently trading at around 45 to 50 times. So if you see here, valuation wise, 45, 50 times, EPS growth around 15%. So it is on the expensive side right now. So if show you here on the chart, so if you see somewhere around 4,300 levels, it faces a resistance and then it sells off from there. So one has to cautious, can't buy it right now. Let it dip a bit, because it is at around 2.5 times PG, which is slightly expensive. So wait for it to decline to get into this stock. I have finished. We'll take questions now.